The markets just wrapped up a volatile Friday, and investors are still processing what happened. Stocks sold off sharply after Donald Trump took a tough new stance on China, specifically targeting the country's rare metals and critical minerals. This isn't just political noise. This hits at the core of global supply chains that power everything from electric vehicles to semiconductors and even defense systems. Let's break down what's going on, why it matters, and how investors can think clearly in the middle of the chaos. So here's what sparked the drop. Trump announced he's considering a 100% tariff on Chinese imports and hinted at canceling his upcoming meeting with President Xi. On top of that, China had already moved to tighten export controls on rare earth elements, the materials that the United States and most of the tech world rely on. The market saw that combination as a major escalation in trade tensions, and risk assets immediately sold off. Tech stocks, which depend heavily on rare materials for chips and batteries, were hit the hardest. Industrials and manufacturing names followed. Meanwhile, safe havens like gold and treasuries caught a bid as investors looked for protection. So what really drove the fear here? It's not just the tariffs themselves. It's uncertainty. Investors hate uncertainty, and this situation is full of it. If trade relations between the world's two largest economies start breaking down again, it could raise costs, disrupt supply chains, and cut into corporate margins just as companies are trying to recover from a high-rate environment. And let's be honest, markets were already stretched. Valuations were high, volatility was low, and many investors had assumed the United States-China tension story was behind us. Friday was a wake-up call. So the real question is, how should you react? First, don't panic. Market shocks tied to policy headlines can reverse just as quickly as they appear. The key is to separate noise from real change. Second, reassess your exposure. If your portfolio leans heavily into tech, industrials, or any company that depends on Chinese manufacturing or rare materials, you might want to trim or hedge some of that risk. On the other hand, this kind of pullback can create buying opportunities, especially in sectors less exposed to China or in companies with strong balance sheets and domestic supply chains. Third, pay attention to the potential winners. American rare earth producers and critical mineral suppliers could benefit from a reassuring trend. Defensive sectors like utilities, healthcare, and consumer staples might also outperform if tensions keep rising. Here's the framework I'd use going forward. Over the weekend and into Monday, take stock of your positions. Reduce the ones that would suffer most from an extended trade conflict. If you're holding cash, keep it ready. If tensions ease, that gives you flexibility to buy on the rebound. But if the situation worsens, you'll be glad you didn't overextend. In the weeks ahead, watch for clarity. Will Trump actually implement these tariffs, or is this negotiation theater? How will China respond? The next round of statements from both sides will tell us whether this is a temporary shock or the start of something bigger. At the end of the day, the best investors don't react emotionally to headlines. They react strategically to risk. This moment, as tense as it feels, is a chance to position smartly for either outcome. If you found this breakdown helpful and you want to stay ahead of the next market move, make sure you hit subscribe, share this video with someone who's following the markets, and check out my next update. I'll be breaking down which sectors are most likely to benefit if this trade tension keeps heating up.